So a little bit about Premier Power Solutions. Premier Power Solutions was started in 2005 and has been delivering energy procurement and cost management solutions to customers in 12 states. You can see we're serving over 3,000 clients, a billion kilowatt hours plus under management, a billion BCF of natural gas under management. And we partnered with Geauga Growth Partnership in 2017. Next slide, Hillary. Our scope of our services is certainly comprehensive, and we can meet any of your energy management needs. If you think about it, everything from renewable energy to planning to the simple procurement and risk management services that you would see in the marketplace, we can provide. I put on here a graph that kind of shows a little bit about commercial analytics and some of the ways that we look at customers' energy spend. You can see here that we've broken out customer spend between the actual commodity, the energy, then demand charges, and then coincident peak charges. Because what we're trying to do is utilize a very analytical approach to minimize the amount of money that you spend on energy. So, and that can be done, through a number of different strategies that we've developed here at Premier. So, again, when we talk about it, we believe that we're very good at, handling things from soup to nuts, if you will, to help you reduce the amount of money that you spend on your energy. So, go ahead, Hillary. One more slide. Okay, Ryan's going to go ahead and start a little bit about the weather update and talk a little bit about market fundamentals. So go ahead and take it away, Ryan.
Good morning, everyone. My name is Ryan Foster. As Hillary stated, I'm the Vice President of Sales for Premier Power Solutions. And first, I'm going to start by going through the weather update, the 2020 and 2021 forecast for the winter. So as you look at the outlook on the left-hand side of this slide, you'll see really where we stand with predictions for the winter. And most of the risk, if you look in the eastern part of the United States, is really for cold in December. So we just had a mild, very mild weather temperature in November. And so we'll see what the rest of this month holds. But the primary forecast drivers, when you're looking at, what fundamentally is going to happen in the energy market, you start by taking a look at natural gas. And natural gas here shows neutral, and in my opinion, it's expected to become bullish as we move along and have some recovery from not only COVID, but also have a more normal winter. And so we'll continue to monitor that, and I'll go over more natural gas information in a little bit. From an economy perspective, looking at that part and that driver, you'll see that we've labeled it as bullish with a new administration coming in, potential fracking limitations, with natural gas being the cheapest source to generate electricity. We're bullish on the economy as we look into next year and the remainder of this year. From a weather perspective, we just got through a historically warm winter in the beginning of 2020. So we're not expecting it to be the fourth warmest winter in 50 years as we just experienced in earlier 2020. And so we'll see what happens as we go along, but weather is bullish as well. So transitioning to the right side of this slide, you'll see where we stand from a natural gas storage perspective. So according to the EIA last week, which they produce a storage update every Thursday, you'll see that right now we stand at 3,939 BCF. So comparatively, if you look at the one-year average, we're about 8% better than we were last year, and plus 290 BCF compared to the 5-year average, which is a little bit under 7% better than the 5-year average, which is really more telling. In the bottom chart, you'll see that the blue line represents really the NYMEX movement for a 12-month moving average. And the blue line has followed fairly closely at different times throughout this year to 2016, which is the orange line. And you'll see that if you think back, 2016, that was the last time we had a warmer winter. I can recall, a couple of weeks in February where we had a couple 60-degree days in our region. And so the blue line really was following closely with the orange line. And then we started to see some separation, which in my opinion was really COVID and the challenges that we experienced once we got through mid-March and just demand being very low. But from a forecasting perspective, we're starting to see a pretty significant drop-off because we did have a warmer November. We'll see what the rest of this month holds in January and February. But for sure, the rig count at the very bottom of this slide is about a third of where it was last year. So if you think rig count low, production low, potential for eventually using more storage if the temperatures are colder than what we experienced last year, and then an uptick in the market with some sort of recovery. Next slide, please, Hillary. So looking at natural gas prices from a NYMEX perspective, and this is showing you the gas contract settlement history. And on here, we're showing 2015 out to 2020 and where we stand today. And you'll see where the lines have followed throughout the color coding of each year. And really, the focus from my perspective is, you look at where we've fallen this year. It's been unique in a lot of ways across industries, and energy is also one of them. So if you look at the start, really where the NYMEX closed in January of this year, it closed at $2.15, right? And then after you went from January forward all the way to August, we had less than $2 per MMBTU NYMEX closings. So to put that into perspective, prior to this year, there's only been a handful of times in history dating back to 2000 where the NYMEX has closed below $2. And we have no months in the entire year where the NYMEX for gas has closed above $3. Today, we actually sit at $2.89. So it's a pretty remarkable year with natural gas pricing being very low. And if you keep in mind that natural gas really leads the way with movement of electricity, you'll understand that pricing is favorable to take advantage. Next slide, please, Hillary. So transitioning from natural gas to the electric energy market, these are wholesale round-the-clock pricing for future years. And again, this is showing a 12-month moving average. And on the left-hand side axis, you've got dollars per megawatt hour. And at the bottom, you're showing trade date. We're looking at, where we stand from 2021 all the way out to 2025 as it's more recently begun trading. So the key here is that the market's in contango. So what contango means is that near-term forwards are cheaper than the long-term forwards. So as you go farther out, just from an energy supply perspective, prices get more expensive as you move through 2021, 22, 23, 24, and 25, right? The red line on this chart is obviously the lowest, and it's coming in around close to $26 per megawatt hour, which is pretty remarkable. If you look in the mid-March timeframe, after we got through the fourth warmest winter in 50 years, and really COVID became a challenge that everybody began to face, you'll see that we were historically low, close to where we dated back in July 4th, around that timeframe of 2019. But everything continues to be historically favorable, and it's basically a buying opportunity where we stand today. Next slide, please, Hillary. Continuing on with the energy market piece for electric, this is a nice chart that we wanted to show that Constellation presents current pricing versus all-time lows, 2021 through 2024. And again, this is round-the-clock forward pricing versus all-time contract lows. So when you look, the market that's really impactful for GGP members is the PJM AD hub. So that's the AEP Dayton hub. That's the one that's most liquid that we utilize for pricing within the electric market for First Energy and AEP service territories. And if you look on here, you're seeing that round-the-clock pricing for 2021 is around 7% away from the all-time low. So we're talking an all-time 22-year low. So that's positioned very favorably. Overall, we're looking at prices that are 10% away from the all-time low or better across the board. So again, this is just pointing towards the fact that if you keep things kind of in order, energy supply is really low based on what's going on with natural gas, demand, storage, and weather. And so that's leading the way to move electricity pricing down. And today we sit in our region not far away from the all-time low when you look across terms, 2021 all the way out to 2024. Next slide, please. So next couple of slides, we're going to get into capacity, and it's a fixed cost component that's crucial to understand when deciding what to do with an electric price and what to do with your strategy. So essentially, the definition of capacity is the cost of providing adequate generation resources to ensure grid reliability. So the way that I put it in terms of many customers that I work with on a regular basis is that it's an insurance premium that everybody pays in order to have reliability and for the lights to come on when you flip the switch. And so we might be only needing the excess capacity that we're paying for 8 hours in an entire year, but we pay for it year round in case there's a critical event or critical weather, and that ensures that we don't have any blackouts or brownouts. And so when you look at capacity costs, it's something that makes up about 20% of your price within the AEP and First Energy markets. And it's something that everybody has to pay. It's a fixed cost component, which is dictated by an auction process. So on this first slide here, we're showing the AEP, Duke, and Dayton clearing prices for the auctions. And you'll see that the time frame starts from June 2011 all the way out to what we know, which is May of 2022. The key that I'd like to show you on here is really the last 3 bars. And so the trend in our area was that pricing for these auctions was coming down. And if you look, you'll see June 2020 to May 21, it actually cleared, around the $80 per megawatt hour, megawatt day, range. And then the following year, the last bar chart on here for June 2021 through May 2022, cleared up 83%. And essentially that was caused by First Energy partially claiming that they're going to close all of their local generation, which is 7,000 megawatts. And so there was reliability concern, which helped that auction really clear higher. And so many customers are trying to figure out, next year, June of 2021 through May of 2022, how they're going to mitigate an 83% increase in cost component for capacity. So that's something that we'd be happy to talk to you about specifically to figure out what capabilities you have to mitigate some of that increase. Next slide, please. So the First Energy service territory is in the American Transmission System, which is ATSI. And so what you see here is the history of the capacity auction clearing prices. And so this chart shows a little differently than AEP. And you'll see that the first 3 bars came in really low when the economy was struggling and demand was low. Then June 15 to May 16, it cleared historically high, almost $300 per megawatt day. And then similarly, as you move to the end of the bar chart, we had a downward trend as more natural gas plants are coming online, so we have nice mix and plenty of capacity available. Then a concern of plant closures across the board. And so in this zone, it's going up 223% starting next year compared to the previous year. So again, very critical to understand capacity and the costs that are associated with it and what actions that you can take strategically to avoid paying a premium or paying max payments for capacity. So definitely something that is worthwhile to talk about from a demand charges perspective. Next slide, Hillary, please. So last slide here on capacity. So we've been waiting to have a capacity auction since May of 2018. That's the last one that we've had. Historically, these auctions are done 3 years in advance of actually using the capacity years. And we've been on delay because PJM, the grid watchdog that handles the auction process, been trying to figure out how to adjust the rules to adequately compensate for nuclear, to compensate for some of the plant closures, and really the transition to natural gas. But if you look on here, they recently released their schedule for conducting the capacity auctions. And like I said, we've been waiting for about over 2 years for this. And so in 2021, we're going to actually have 2 auctions to try to get caught up. Same thing in 2022. So the next auction will take place in the May timeframe, and it'll dictate what's going to be the capacity clearing prices for 2022 and 2023 delivery year. And then you'll see on the rest of the chart how the auction process will go. And it'll be interesting to see, where these prices clear. There's been talk about, adequately compensating nuclear, like I mentioned on the last slide. And there's plant closures that have taken place across the board. Some states have looked at capacity hard and seen if they wanted to branch out. So there's a whole bunch of activity around this schedule. So it'll be very interesting to see where the prices clear. Hopefully they clear favorably and lower than what took place on the last bar chart that we know for the May 21 to June 1st of 2022 period. And with that, I'm going to transition over to Lee for a regulatory update on House Bill 6. Lee?
Thank you, Ryan. The next thing we want to talk about, is the Ohio House Bill 6. Now, I'm sure everyone here is familiar with House Bill 6, but just to give a quick refresher, House Bill 6 had a couple of different things that it did in its substance. It provided financial assistance to some nuclear plants and that are located in the state, and also a subsidy for some coal plants. So actually, one was located in Indiana. The other thing that it did was it really removed the existing renewable portfolio standards. In other words, the push towards renewables was pretty much halted, and it removed the energy efficiency programs that were previously in place. As sure as many of you, have received reimbursements, under the energy efficiency program for doing things like LED lighting upgrades and those types of things. So House Bill 6 was really designed to ensure that, our nuclear plants that are located in the state of Ohio maintained the operation, as well as subsidizing some coal plants. So that legislation was, I guess I'll use the word controversial. I mean, there were some folks that believed it was a very good thing for the state. Some believed it was not necessarily a great thing for the state and consumers. So what's happened over time here is, as I'm sure most people on this call would understand, that there's been some investigations around House Bill 6 and around some folks at, they don't specifically name, but we've seen some activity, within First Energy and also within the Pennsylvania, or the Public Utility Commission of Ohio as well, where we've seen some individuals, being removed from positions or resigning. And so one of the things that's happened is that there's been a bill, House Bill 772 has been introduced, that would actually repeal House Bill 6, which, there's a number of folks out there that say that's a great thing. But if we repeal House Bill 6, if that's what ends up happening, we have to figure out, okay, so we're going to repeal it, but what are we going to replace it with? Are we going to bring back the renewable portfolio standards? Are we going to bring back energy efficiency programs? What's the mechanism that would be used for all of those things? So, it's not as simple of a process as, let's undo one thing and then just not replace it at all. I believe that there needs to be some thought given to, and that's what House Bill 772 is doing, is to make an attempt to protect the customers, the markets, and, while at the same time ensuring that some of the other provisions that people would like to see, perhaps around renewables or energy efficiency, are also addressed at the same time. So there's a lot of things out there. If you get on Google, you can Google House Bill 6, House Bill 772. You can see a number of things that are going on. And so you think about, how's that going to impact me as a consumer? Well, as a consumer and a user of electricity, and most people on this call are going to be significant users of electricity, you look at all of the different riders that First Energy has and how they're treating certain costs and today, and how they might do it under House Bill 772. I think an analysis of those things needs to be completed so we can understand what the exact impact would be on you. So I think that the bottom line is, I think the impact could be significant. It's going to be different on a customer by customer basis, and at the end of the day, it's something that as the law becomes clearer, or the repeal becomes clearer, and the replacement becomes clearer, that's something that we would certainly be willing to help you out with and help you understand what the impacts are going to be to your business. So, you want to go ahead and next slide, Hillary? So things to think about in today's market, moving beyond the regulatory impact and start to think about, COVID-19, we've been in this COVID period now for 7.5, 8 months of serious financial impact and operational impact on our businesses. So we need to be thinking about what impact that actually has had on the energy market. So by thinking long term, okay, because it appears that there may be a light at the end of the tunnel, okay, so, and if you're in a position where you think that your business is going to be coming back and perhaps even thriving, because we're actually seeing certain businesses do very well during this pandemic, we should probably take advantage of the fact that we're in a very good buying window right now. Buying during lower periods of market pricing, which I think if we go back and look at some of the slides that we presented earlier on where we stand versus relative market lows, we think about the AD hub in Ohio, which is where most of the pricing comes from for Ohio consumers. We're within about 10.6% of the lowest that energy has ever traded. So that's something that, if you can buy, I always, like to think of it with customers. If we can do our job, if we can buy within 10% of as low as it has ever traded over the life of that particular period of time. Another thing to be thinking about, though, is, considering the financial stability of the actual energy supplier themselves. Now, we know that, as an example, House Bill 6 was providing a subsidy to, Energy Harbor as a part of the mechanism within House Bill 6. Now what the impact of a potential repeal of House Bill 6 could have on Energy Harbor, I'm certainly not going to speculate on that at this point. But when you think about what's happening in the markets, that's one example. Another example would be, the suppliers, many of them, they expected customers to use more energy than they are using today. And so that has an impact on the suppliers, because if you own a bunch of generation and you don't have anyone to sell it to, that's not a positive thing for you, right? So thinking about the different suppliers and where they're at relative to their own financial stability is something we need to be concerned about as well. And how do we protect ourselves in those things is, by looking at the energy supply contract language, right? The energy supply contract language is probably one of the most overlooked things that you would find in the marketplace, where people would say, okay, all I'm really worried about is I got my number, I got my price, it's all well and good, I'm going to sign my contract and be done with it for a couple of years. Well, sometimes that works, sometimes it doesn't. And so understanding what provisions may or may not be within that contract language that allow your supplier to change your price is something that's very important. So we need to think about that as well. And another thing that we need to do is as we move forward in time and we see, certainly some changes occurring in the energy industry around renewables, we need to be thinking about renewables, what we can do with renewables to lower our cost structure, what we can do to create maybe some price stability in our pricing, because renewables, when you purchase them, or if it's something like solar, for example, there may be an opportunity there for you to lock in prices for 15 years, right? So you could understand what your price is going to be. You could get price stability and something that might make good sense for you for the long term. So those are a few of the things that we think about whenever we're talking to customers, and that are probably more relevant today because of COVID and some of the things that it has certainly impacted. So I'm going to stop there, and go ahead, and Hillary, you'll put on the next slide. We're going to move to the Q&A session and see where we're at with that. And again, thank you very much, and we'll be answering a few of your questions here. If you have them, please go ahead and send them in on the Q&A chat.
Thanks. We do have a couple of questions, so I'll just start it off. The first one is, my contract is ending in August of 2021. Can I still lock in today's prices for my next contract?
So I'll take that one. So the answer is yes. You can definitely take a forward position for an August 21 start. As I showed earlier graphically, we're in a historically good position from an energy supply perspective. And forwards actually are trading all the way out to 2025. So regularly, we're looking actively with customers to figure out what positions to take, what product. Our approach is very customized and specific to the client based on how they use their energy and what they're looking to accomplish. One of the greatest strengths I think we have as a company is listening to what the customer needs. And so we'd be happy to take a look at an August 21 start today and see if it makes sense to actually take an action or whether or not to put it on market watch or do something different. And as Lee talked about, there's a lot of factors that are relatively new that go into an energy decision based on the customer. And so we'd be happy to meet with you and speak in more detail about your specific situation.
Great. Thank you. Here's another one. What are your predictions for the capacity auctions next year and beyond? Is there any way to manage this cost?
So we went over capacity auctions in a couple different slides earlier, and capacity predictions are very difficult, to say the least. I spent the last 15 years of my career helping large energy users in a customized fashion, and half of that time spent on the supply side with a major supplier that owned local generation. And so even some of the best people that bid into the auction had a really hard time forecasting how those auctions would clear. Expectation-wise, if I was to look into a crystal ball, hoping that it clears lower than what it did back in the May 2018 timeframe for that 2021, 2022 delivery year, and comes in around that $100 per megawatt day range. PJM consists of 13 different states, and that's kind of like more of an average of what we've seen within our marketplace versus where it cleared last, especially with the natural gas generation being cheaper. So we'll see where it actually comes out. And, again, that's just Brian's prediction, but we'll see where it comes out, next May for sure.
Thanks, Ryan. Here's another one. How can the House Bill 6 decision impact my manufacturing company? I'm a secondary customer based in an illuminating coast area.
Sure.
I'll let you take this.
Yeah, I'm gonna go ahead and take that one. House Bill 6, is the decision on whether that, either goes away or, if you will, or gets repealed or gets replaced. That hasn't been made yet, right? There's a lot of arguments out there. There's certainly been some arguments anyway, saying that, the substance of House Bill 6, there's still people out there that support that. There's, a pretty strong group that are saying that, yeah, but the way that House Bill 6 was passed isn't necessarily acceptable. And so, when we think about, House Bill 6 and whether or not it's repealed or whether or not it remains intact in some form, to figure out what the impact is going to be, specifically on a company is going to be very difficult, because the decision to either repeal and replace or just repeal or perhaps just modify, really has not been made yet there's no final decision been made. So at this point, it's difficult to say. If you look at, what I'd be thinking about is, some of the, basic fundamentals. I'd be looking at trying to understand how to, make sure that my demand charges are minimized, that I'm being as efficient as I can in my consumption so that I can use less energy, have less demand, because those are some things that, based upon how this situation gets resolved, will have an impact on, one way or the other, will have an impact, on your total cost. So it's a difficult question to answer until we have a better feel for which way the decision is going to go. So I'm sure I didn't really answer your question, but the bottom line is we just don't know yet. But it's certainly something that we're monitoring and keeping very close track of.